The year is 1987. Michael Milken sits in his Beverly Hills office, trading junk bonds worth billions, while the Soviet Union crumbles 6,000 miles away. On the surface, these events seem unconnected. They weren't. When historians write about the Cold War's end, they mention Reagan's speeches, Gorbachev's reforms, and the fall of the Berlin Wall. They rarely mention the leverage buyouts, currency swaps, and debt instruments that actually brought down the Iron Curtain. Wall Street didn't just watch the Cold War end. It orchestrated the finale. This is another video where money, power, and history collide, and nothing is ever as simple as it looks. The official story sounds noble enough. America's financial system represented freedom, innovation, and prosperity. The Soviet command economy represented control, stagnation, and scarcity. Free markets triumphed over central planning. Democracy defeated totalitarianism. Case closed. The reality was messier, more cynical, and far more profitable. The Cold War wasn't won in missile silos or diplomatic summits. It was won in trading rooms, corporate boardrooms, and the opaque world of international finance. The weapons weren't nuclear warheads, but currency fluctuations, commodity manipulation, and deliberate market volatility. Wall Street had learned something the Pentagon never understood. You don't defeat an economy by threatening to destroy it. You defeat it by making it dependent on you. The mechanism began in the 1970s, when the Soviet Union made its first fatal mistake. Faced with grain shortages and technological gaps, Moscow turned to Western credit markets. Soviet planners believed they could borrow American capital while maintaining communist ideology. They were wrong. Every loan came with strings. Every credit line created vulnerability. The Soviets thought they were buying wheat and machinery. They were actually selling their sovereignty, one transaction at a time. American investment banks didn't need a conspiracy. They just needed math. The more the Soviets borrowed, the more they needed to export to service the debt. The more they exported, the more dependent they became on Western commodity markets that Wall Street increasingly controlled. Chase Manhattan arranged the loans. Goldman Sachs structured the deals. Morgan Stanley managed the currency swaps. Each bank earned fees on every transaction while slowly tightening the financial noose around the Soviet economy. The genius was in the commodities trade. By the early 1980s, the Soviet Union derived 60% of its hard currency from energy exports. Oil and natural gas sales funded everything from military spending to consumer goods imports. Moscow had become a petrostate masquerading as a superpower. Wall Street banks had learned to treat commodity markets like casino chips. They could drive prices up or down through futures contracts, derivative bets, and coordinated trading strategies. When oil prices needed to fall, they fell. When grain prices needed to rise, they rose. The Saudis provided the muscle. In 1985, Riyadh opened the oil spigots and crashed global energy prices from $30 per barrel to below $10. The official explanation blamed market forces and oversupply. The truth was simpler. It was financial warfare disguised as economics. Soviet revenues collapsed overnight. The Kremlin faced a choice between defaulting on foreign debt or cutting domestic spending. They chose austerity. Military budgets shrank. Consumer goods disappeared. The social contract between the Communist Party and the Soviet people began to fray. American investment banks profited from every angle. They earned fees arranging emergency credit for cash-strapped Soviet enterprises. They made money betting against the ruble in currency markets. They structured deals to buy Soviet commodities at fire sale prices. The puppet master was Paul Volcker, chairman of the Federal Reserve. Volcker understood that controlling global interest rates meant controlling global politics. When he raised American rates to 20% in 1981, he wasn't just fighting domestic inflation. He was making it impossible for debtor nations like the Soviet Union to service their dollar-denominated loans. Every percentage point increase in American rates drained billions from the Soviet treasury. The Kremlin faced the same choice as any over-leveraged corporation: restructure the debt or face bankruptcy. Gorbachev's reforms weren't born from ideological awakening. They were born from financial desperation. Perestroika and glasnost were essentially bankruptcy proceedings for a failed state. The Soviet Union was being liquidated like any other distressed asset. Wall Street banks circled like vultures. When state-owned enterprises were privatized, American investment banks structured the deals. When natural resources were sold to foreign investors, Wall Street arranged the financing. When oligarchs emerged to buy Soviet assets for pennies on the dollar, guess who provided the credit? The Berlin Wall fell in 1989. The Soviet Union collapsed in 1991. But the financial strangulation had begun a decade earlier in the trading rooms of Manhattan. The Cold War ended not with nuclear winter, but with a liquidity crisis. The weapons of financial warfare proved more effective than any missile system. Currency manipulation destabilized the ruble. Commodity price manipulation starved the treasury. Interest rate manipulation made foreign debt unsustainable. Debt restructuring forced political reforms. The Soviet military never surrendered. The Soviet economy simply ran out of cash. The most elegant part was plausible deniability. Every action could be explained as normal market behavior. Oil prices fell due to oversupply. Interest rates rose to fight inflation. Currency values fluctuated based on economic fundamentals. Nobody could prove deliberate coordination. The paper trail was buried in derivative contracts, offshore accounts, and classified Federal Reserve communications. The real Cold War archives weren't stored in CIA headquarters, but in the basement of the New York Federal Reserve. American taxpayers never saw the bill. Wall Street funded the operation through profits from international lending, commodity trading, and currency speculation. The financial war paid for itself while generating enormous returns for participating banks. The Soviet Union became the largest corporate bankruptcy in history. The asset stripping lasted for decades. Russian oil reserves, Siberian mining rights, and Eastern European markets were sold to the highest bidders. Wall Street banks earned fees on every transaction. The names have changed. The playbook hasn't. The same financial weapons that destroyed the Soviet Union are deployed today against any nation that challenges American economic hegemony. Currency manipulation destabilizes rivals. Commodity price swings punish adversaries. Interest rate policies reward allies and punish enemies. China learned the lesson. Beijing accumulates foreign reserves to avoid Soviet-style financial vulnerability. Russia learned too late. Iran and North Korea learned by watching others suffer. Financial warfare works best against nations that believe in market rules their enemies control. Modern conflicts look like trade wars, sanctions regimes, and currency crises. The underlying dynamic remains unchanged. Whoever controls global finance controls global politics. Military force has become the last resort for nations sophisticated enough to wield economic weapons. The Federal Reserve operates like a global central bank. Wall Street functions as the world's financial enforcer. American investment banks profit from both the creation and resolution of international crises. The system that defeated communism now polices capitalism itself. Central banks coordinate policy through private meetings and encrypted communications. Major investment banks share information through informal networks and revolving door personnel. The financial elite operate above traditional concepts of national sovereignty or democratic accountability. The Soviet Union fell because it trusted a system designed to destroy it. Every loan was a trap. Every trade agreement was a surrender. Every financial integration was a step toward economic annexation. The Cold War taught Wall Street that military conquest was expensive and obvious. Financial conquest was profitable and invisible. Why invade a country when you can simply buy it? The institutions that orchestrate modern financial warfare operate in plain sight. The Federal Reserve publishes meeting minutes. Investment banks file public reports. Central bank governors give speeches explaining their decisions. The machinery of financial empire builders itself with public transparency. The true victory of capitalism wasn't ideological. It was institutional. The Soviet Union fell not because communism failed, but because it tried to play by capitalist rules while rejecting capitalist logic. You cannot borrow from a system designed to own you. The Cold War never ended. It was simply privatized. The conflicts between superpowers became competitions between financial systems. The nuclear standoff became a liquidity standoff. Mutual assured destruction became mutual economic dependence. Wall Street won the Cold War by making it profitable to lose. The Soviet Union discovered that in global finance, the house always wins because the house owns the rules. The greatest military power in history was checkmated by accountants with calculators. The people who control the world's money don't need to conquer nations. They just need to invoice them.